Welcome to this trading skills section of Forex Academy 101. We'd like to touch upon some factors that we believe are very important for any Forex trader. Indeed, for any serious trader on any market. Most of these issues will be touched upon in greater depth in our other films and articles, but we just thought that it would be good to have them packed together in a single place. A golden rules collection, as it were. Alright, are you ready? Here's the first one. Always have a plan. While I myself started out viewing this whole Forex thing as just another big casino game, I've learned the hard way that in the long term it pays to have a plan. It's all well and good to try to intuit what the market will do next, and you may even make some money that way at first, but the novelty soon wears off. Especially after intuiting the market wrong for 10 consecutive times. While it may seem stifling to follow a plan, it is the only way to survive the Forex market. Whether you are a technical trader or whether you focus on the fundamentals, it's important to know what you're waiting for. Formulate an hypothesis about the development of the market, set entry and exit triggers, and let the magic happen. I'm saying it again because it's so important. This is the only way to survive. Rule number 2 is about money management. Simple but very important. If you don't heed this, you might as well go out gambling, because no matter how solid your plan is, sooner or later you will lose your money. First of all, never put more than 5% of your total trading capital into any one trade. Any trade may fail. Heck, 20 trades in a row may fail just as easily. Your money is your toolbox. It's the bricks that build your Forex house. It's the bullets you fire into your enemy's camp. It's very important that you protect your vulnerable trading capital, and the only way to do that is by taking it very easy with risk. Incidentally, the more capital you have, the smaller the percentage you get to play with on any one trade. The more expensive your toolbox, the more protection it needs. Second, always put your stop loss. Don't even think about leaving that out. If you follow the first rule and have a plan, you know what risks to take and you know what rewards to expect. Again, you need to protect your investment, and one of the ways to do that is by allowing for the off chance that you might not be right. Of course, when you are right, you need to make it count. So that's where rule 3 comes in. Always have a healthy risk-reward ratio. Whether or not you use a take profit is a personal choice. I personally like to set it up and then play with it to see whether I get to squeeze some more juice from the rocks. But some traders never put a take win. That's alright too, just as long as you realize that the stop loss you put defines your risk. If you risk, let's say, 25 pips on a seemingly profitable trade, you better get at least around 40 pips profit from it. That way, if your ratio of winning to losing trades more or less equals out, you've got some profit left. Always make sure that your risk-reward ratio on any trade is higher than 1. Otherwise, you're simply cheating yourself. Let your profits run. Rule number 3 is actually a collection of commonsensical rules that make sure you're acting efficiently. The first one, trust your broker. If you feel that you cannot trust your broker, look for another broker immediately. Sadly, the internet Forex world is poorly regulated, and there have been bad brokers in the past. ForexAcademy101.com has a few recommendations. But those guys certainly are not the only good guys in the market. I'd advise any serious trader to test a broker on a few key points. 1. The speed of support. Just send them an email complaining or inquiring about something and see how fast and in what manner they react. The second, transparency of rates. Most brokers live off the spread, which is the difference between the bid and the ask price. They need to be transparent about this, otherwise you never know quite what you're paying them. And by definition, you only have a vague sense of the profitability of your trades. You can't have that. The third, is their platform stable? This matters especially in times where markets are volatile. You don't want to be unable to open, or worse, close out your position. The fourth and final rule to look for in a good broker is to look for other people's experiences with them. The web is full of rating sites, and I know there is a lot of fluff to cut through, but if a broker is truly a scammer, it's best to find out sooner rather than later. The second common sense rule: don't trade with money that you can't miss. This causes you to lose your cool and act accordingly. You need to trade without much passion and mostly not let the money aspect bother you. And the third rule: don't trade when you're upset. This influences your decisions and you need to be pretty balanced to make it through a day of trading anyway, let alone a week or a month. So if you're upset, do not trade. For more information, trading videos and articles, go to forexacademy101.com.